Hi guys, welcome back to another video. So in this video, I will be sharing about the recent business updates on regarding Keppel DC REIT. And Keppel DC REIT, being a pure data center, was one of the only pure REIT that focuses on data center until recently, where last year Digital Core REIT actually listed in SGX as well. So with the recent rate in markets, it provides opportunity for us to look at some valuable stocks and REITs to buy. Of course, Keppel DC REIT was not spared, as well as Digital Core REIT. If you look at Keppel DC REIT, the share price from year to date has dropped about 25%, but in the long run, since 2016, it's still up a very good value of 80 to 90%, which again shows the long-term prospect that investing works. Whereas for Digital Core that was listed last year, not doing that well, as you can see from the chart. So in general, Singapore markets are not as attractive as compared to the US market. However, there are still some gems that can be found in the Singapore market. And today, I will share with you on the reasons why you should consider Keppel DC REIT and how they are one of the only rare REITs that recently announced a higher DPU. So let's take a quick look at the assets of Keppel DC REIT. So as you can see, for those that are new to Keppel DC REIT, Keppel DC REIT has majority in assets of Singapore at 54.4%, whereas other countries are currently expanding as well. As you can see from this hint here, they are obviously targeting other countries' data centers if there is opportunities. There is also potential data center assets of acquisitions from their subsidiaries or sister companies of Keppel TNT and Keppel's private data center funds. So this is one of the reasons why they are having this kind of advantage, where the REITs are valued at a higher price because they have strong sponsors and businesses behind their back to support them in times of needs. Moreover, buying from sister companies tend to benefit them as they are related to one another. So looking into their key highlights, I would like to first focus on this section here only, as the other sections will be presented in the subsequent slides. So as you can see, this is very important because a lot of people are questioning about their electricity cost and inflation that is affecting their expenses. So because of this, in this quarter, you notice that they are actually emphasizing a lot on property expenses, and they mention about how they fix the electricity costs for their colocation assets for 2 years. So I'll explain more on what is colocation assets later. And they have also significantly above 90% of the electricity cost has been passed on to their clients. So this is good because this means that the clients will be taking in the expenses rather than Keppel DC REIT themselves having to worry about the rising electricity costs. Moreover, with the recent drop in the oil prices, if you follow it closely, this means that in the long run, Singapore would lower in electricity costs. As you can see from the SP Group, recently, electricity tariffs have decreased for the first time in the quarter, which is a slight win for not only Keppel DC REIT but also for most of the REITs if their capital expenses can drop. So, for the impact of the inflation is also partially offset by renewals and income escalations. So this means that their renewals are able to help to offset the impact, which is a good news. Okay, so this is the important part where we focus on their balance sheet. So in the revenue, is as usual, there is slight increase only. So this is not a big thing. But if you observe at this quarter or this business update, they provide a very interesting value, which is the property expenses. So looking at this value, if they compare year over year of the third quarter, the property expenses actually increased by a very high value of 12.1%. However, if you go and take notice of the first half of 2022 of the previous report, because the Q1 do not show any property expenses, we can see that the property expenses is at a value of 12,305. And if you average it out between the 2 quarters, the first 2 quarters was at an average of 6,152.5, and by comparing to 6,235 of the recent quarter, is increasing at a rate of 1.34%, or an annualized rate of 5.63%, which is significantly lower as compared to this value here. So this is a very good thing, or a good move by the management in order to address the property expenses concern. So therefore, their property income came in at a surprisingly higher value, when even though the property expenses increased like a very large value if you compare year over year. So for finance income came in from the Netco bonds and the coupon income from the Guangdong data center. So the management was very smart in investing in these Netco bonds, whereas a lot of people previously had questions about their investment in this company bond of their sister company. So because of this bond, they are able to get an attractive coupon rate at 9.17% for 15 years. So I'll expect their finance income to remain stable at about 2,000 plus for the subsequent quarters. And if you look at the distributable income, it came in at a higher value of 9% year over year, thus allowing shareholders to receive a higher DPU of 5% at 2.585. And this is a very good thing because they are only one of the REITs that recently give a higher DPU. So the revenue was partially offset by the following factors, such as lower contribution because some colocation assets that they have to pay utility expenses are coming in at higher, that's why it result in a higher property expenses. So that's why it's important for the managements that are getting new colocation assets or clients that push the utility costs to the clients instead of taking it themselves. Moreover, overseas currencies will affect Keppel DC REIT as well. Therefore, depreciation of the respective countries against SGD causing lower revenue, and divestment of assets thus bringing in a lower revenue. Now let's look into their occupancy and their average lease of tenancy. So if you can see, they have an increase of 0.4% to a high occupancy of 98.6%, whereas their average tenancy lease increased from 7.6% to 8.7%. So one of the good things about data centers is that they will always have or tend to have very high occupancy and a high average lease, because tenants do not like to move or are able to move as easy as compared to other REITs of logistics or industries, because data centers are built or have a lot of structures that they would require, and moving it to another data center would mean that they will have to shift everything and their data as well, making it very hard. And so the good thing is that customers tends to stay in data centers for the long run. So the management also did a very good thing, as you can see from this important line here, that they built in income and rental escalation based on CPI data. So I assume that this is based on the respective countries. So this makes Keppel DC very resilient in inflation as well. Moreover, there's also a slight win in the Keppel DC Singapore 5 of increasing the land lease from 19 to 28 years. And as they have stated just now, they have fixed 90% of the electricity costs by passing it to the colocation assets clients. And if you see here, this profile here shows a very attractive, good average tenancy lease that will only expire from 2025 onwards. So just want to highlight on some slight occupancy rate flags is that for these assets in Malaysia data center, although it's a very small asset, the occupancy actually went down from 63.2% in Q1 to 40.2%. So this was actually questioned in the previous earnings call as well. So for the next quarter, it will be interesting to see whether it will increase or decrease, and whether people will ask them and what will be the management response. However, they have other assets which increase in occupancy as well, as you can see in Ireland and Netherlands, which are much bigger data centers, thus cancelling out the decrease from the Malaysia data center. Okay, so if we look at the client base slides here, normally for fully fitted and shell and core, they are triple net lease. So what does triple net lease mean is that the clients would pay for everything including the utility expenses, and they tend to be very sticky as the buildings are specially fit for the customers, thus making their average lease very long. As you can see here, they are at a average long lease of 12.4 and 8.4. However, the negative part is that they are only single tenants because it's fitted for them, so thus the whole data center tends to be only a single user. But it's also a slight risk in the event if the tenant collapses. So for colocation assets, even though some clients would negotiate and management have to pay more, or Keppel DC REIT have to pay more, it actually brings a lot about some benefits but also some cons as well. So for the benefits, firstly, it provides Keppel DC with the flexibility in negotiating for better rental contracts, as DCs are heavily in demand. Some customers would also prefer owners to manage DC as they do not have the expertise, thus allowing the REIT to attract new customers that are not available through the shell and core or fully fitted. Thirdly, they can also have multiple customers compared to a single customer, bringing more stability to the income. As you can see, the client count is considered multiple. Okay, so how about the cons for colocation assets? Firstly, customers only pay rents, and while the owners bears all expenses unless negotiated. And secondly, it's higher chance for the customers to change location, because as compared to the shell and core and fully fitted, they can have more chance to shift around, even though it's also, of course, it's still quite hard, but there is higher chance of them moving as compared to the rest of the assets. So with the high interest rate, every REIT definitely has to have a very good debt balance sheet. As you can see, for Keppel DC REIT, its balance sheet is very good. As you can see, at of course, the average leverage of 37.2%, the cost of debt is only at a decent value of 2.3%. Moreover, they have a very high ICR of 8.5 times, making it very safe. Moreover, if you see from the slides, there is a debt profile of from 2022 to 2025 at very low values. So this makes it very good, because all these recent renewal debts are from Australia and Europe, which tends to have lower interest rate as compared to Singapore or China loans. So because of this, Keppel DC REIT would normally have an advantage when it comes to refinancing compared to other countries that have to refinance in SGD or in USD. So with 26% of the loans unhedged, the impact of 100 basis point increase would impact about 2.1% of the DPU. So if the management does well, they would continue to outpace the decrease or the impact by the interest rate, thus able to give a higher DPU like this quarter. So they are smart as well, because they hedge the loans of the respective assets into their respective countries of the assets as well. As you can see, the Euros, the Singapore, UK, Aussie, and RMB. So because of this, they might have a slight advantage, because as the currencies of other countries drop, it tends to make the loans cheaper as well. So if you look at these slides, although net asset value for REITs are not as important, if you look at the unit price and the assets and comparing it to the premium, currently the slides, although the slides is showing a dollar of 170, its current price of around $1.85 is at a decent valuation premium of 38%. As you compare to last year, where at the $2.47, the premium was at a ridiculous value of 84.3%. So this premium is actually considered very low compared to the past, where Q3 of last year was at a ridiculous value of 101%. At a low value of 38 or 26.9%, its value is comparable all the way back to 2016, where the premium was at 24.2%. So this actually shows how much people are pricing in the data centers or the REITs market in general, thus providing us with the opportunity to invest at good valuations. So what we can conclude is that Keppel DC REITs management have been very good in using data centers demand as an advantage to increase rental costs and decreasing their expenses or property expenses by renegotiating with clients. Moreover, they have good sponsors and management to back them up in the event if there is any issue, and this makes Keppel DC REIT a very resilient REIT, and being one of the rare REITs to increase in the DPU further justifies that. So in my opinion, I feel that Keppel DC REIT is a REIT that can hold for the long run for stable returns, and at the current yield of 5.5% is a very attractive yield, whereas it was usually priced around 4% yield for the past few years. However, interest rate was low for the past few years. Therefore, this has to be taken into account when you are making decisions in your investment, especially in REITs. I hope this video helps to bring more clarity to Keppel DC, and please do more research on making any investment decision. If you still till the end, you're amazing. Please subscribe, like, and comment if you agree on what I conclude from their recent results. Thank you so much for watching, and you can look at my previous videos where I did similar analysis on other REITs as well. Thank you, and to the next video.